There's been a lot of talk about potential interest rate cuts over the last 6 months and how these need to happen as soon as possible in order to save commercial real estate borrowers that are either at risk of default or already in default. But even though interest rate cuts could be helpful in some scenarios, these might not have the kinds of widespread positive impacts that people are talking about right now. And in this video, I want to highlight a few reasons why decreases in interest rates might not provide the kind of relief that investors are hoping for, and some more concrete numbers behind why this might not be the case. So the first reason why interest rate cuts might not prevent distress in commercial real estate is because these just might not end up happening quickly enough. According to data from the Mortgage Bankers Association from the end of 2023, $660 billion of commercial real estate loans were projected to mature in 2024, but in February of this year, the MBA revised these figures and increased these projected maturities by 41%, up to $929 billion maturing this year due to loan modifications and extensions pushing these from 2023 into 2024. This is what's commonly being referred to right now as extend and pretend, with investors holding on to underperforming properties and working out extensions with lenders with the hope that interest rates will end up falling quickly enough in order to prevent distress. But back in January of this year, as many as 6 rate cuts were expected to be made in 2024, which is why many of these borrowers pushed to extend these loans to ideally refinance into a lower interest rate environment. But with inflation numbers that keep coming in stronger than expected, as of early May, we still haven't seen any rate cuts at all. And based on today's forward curves, the market is now only pricing in up to 2 rate cuts over the next 6 months. Many commercial real estate borrowers with floating rate loans also have interest rate caps that limit their maximum interest rate exposure for a set period of time, but many of these are also expiring over the next 2 years, and purchasing a new interest rate cap would require a significant upfront payment that most borrowers that are already struggling with cash flow just don't have. Ultimately, these rate cap expirations and loan maturities are creating a huge sense of urgency for borrowers right now, and rates would have to drop materially in the very near future in order to make a difference. And this leads into my next point in this video, which is that even if rates do go down in the second half of this year, rates will very likely not drop low enough in order to prevent distress. If we take a look at the 1-month SOFR, which is the standard index rate used for floating rate commercial real estate loans in the US, this was sitting at about 5.3% as of the beginning of May. And even though, according to forward curves, these rates are projected to drop pretty substantially over the next 18 months, a 4.1% SOFR in the beginning of 2026 isn't going to do much to move the needle for most borrowers in this industry. Commercial real estate loans with a floating interest rate are priced based on an index rate, which is often this 1-month SOFR, plus an additional spread that's added to that rate, which usually comes in somewhere between about 250 and 400 basis points. And this means that even if we do see the kinds of rate cuts the market is pricing in right now, the all-in rate on floating rate loans with an industry standard spread would still come in between roughly 6.6% and 8.1% in the beginning of 2026. And if you factor in that most of these loans were originated at a time when SOFR was effectively zero, and most of these deals only penciled with all-in interest rates in the 2.5% to 4% range, in most cases, even a 6.6% interest rate isn't going to cut it. And to use an example, if we take a look at a property that was acquired for $10 million at the start of 2022 and financed with a 70% LTV, interest-only floating rate loan priced at 1-month SOFR plus a spread of 300 basis points and purchased at a going-in cap rate of 4.5%, which was pretty common in many asset classes in the industry at that time, the going-in annual NOI of the property would be $450,000, and annual debt service would come in at $210,000. But today, even if we assume that this deal saw NOI growth of 3% per year, bringing that annual operating income up to $477,000 2 years later, the all-in interest rate on that same loan would incorporate today's SOFR of 5.3% plus that same 300 basis point spread, bringing the total annual debt service in 2024 to $581,000, causing investors to have to dip into reserves just to avoid default. And even if SOFR did drop as expected to 4.1% at the beginning of 2026, this would only decrease the annual debt service here to $497,000. And assuming that same 3% annual NOI growth over the next 2 years, this would still put the property at essentially a break-even cash flow point even after these cuts are made. And if this investor wanted to refinance at this point into a fixed rate loan with the 10-year treasury only expected to drop to roughly 4.4% by the beginning of 2026, even assuming a tighter spread of 200 basis points on this new loan, that would put the all-in interest rate at 6.4%, which, even though this is lower than that alternative floating rate, this would still make it extremely difficult for the borrower to replace the existing loan proceeds. And this is because most commercial real estate lenders will look very closely at a property's debt service coverage ratio, which measures the number of times over a property's NOI can cover annual debt service, and the minimum value a lender is usually willing to accept here generally comes out to about 1.25x. And in this case, a $7 million loan at a 6.4% interest rate amortizing over 30 years would produce annual debt service of over $525,000 per year, meaning that a $506,000 NOI just wouldn't support this loan amount, and based on a minimum 1.25x DSCR, the maximum loan proceeds a lender would issue here would come in at just under $5.4 million, requiring investors to come up with an additional $1.6 million of equity just to pay off the outstanding loan. And what this all means is that even if rates do go down materially from where they are today, with cap rates where they were during the peak, interest rates would need to drop significantly more than the market is currently forecasting in order to make a meaningful difference in the vast majority of cases. Now, even if interest rates do come down faster and further than expected, this still might not be enough to put the brakes on commercial real estate distress in some areas of the market, which leads me to my last point in this video, which is that property fundamentals are also contributing to declining values and defaults independent of interest rate movements. According to the MBA, 25% of commercial real estate loans maturing in 2024 are backed by office properties, which in many cases just don't have the operating income to support a refinance even at significantly lower interest rates. And according to CBRE's Q1 2024 US office figures, negative net absorption hit 13 million square feet in the first quarter of this year, which was up from just 1.7 million square feet in Q4 of 2023, and office vacancy levels have continued to tick up over the last 2 years, peaking at 19% in the first quarter of 2024. Quarter-over-quarter leasing activity also fell by over 21% in Q1 and by over 13% year-over-year, and year-over-year office using job growth was also negative in some of the biggest employment markets in the country, including Miami, New York, Boston, Los Angeles, San Francisco, Chicago, and Nashville. The bottom line here is that while the multifamily and industrial sectors will very likely have the demand necessary to make it through the supply issues we're seeing in those sectors today, office is seeing a material drop in demand, which doesn't appear to be turning around anytime soon. And with office making up one of the largest asset classes within commercial real estate as a whole, the effects of office distress will inevitably have a major impact on the industry, even if interest rates drop significantly more than expected. Now, this might all seem really negative, but ultimately distress leads to opportunities in this industry, and with the shot clock running out on many borrowers who over-leveraged their deals in 2021 and 2022, it looks like there could be a significant amount of buying opportunities coming up in the very near future, which is very positive news for you if you're looking to break into the commercial real estate industry today. If you want to make sure you have the skills you'll need to be ready for opportunities when transaction activity and hiring ultimately pick up, and you're prepared to pass an Excel modeling exam that might be given to you during the interview process, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the current state of the real estate market, make sure to hit the like button and let me know in the comments where you think interest rates might go throughout the rest of the year. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.